Ladies and gentlemen, good afternoon. Thank you very much for taking the time to attend our seminar entitled Preserving and Protecting Your Family Wealth. We're a little bit nervous choosing this day. Wimbledon, the World Cup, so we're very pleased you've chosen us over Andy Murray and Argentina. For those that haven't met me before, my name is David Stockdale, and myself and Andre will be presenting to you today. Let me tell you a little bit about our agenda. I think the key objective is for you to leave this presentation with a greater understanding of estate planning. And in our language, estate planning is ensuring that the right people get the right money at the right time. We're also going to talk to you about the risks that many families face, which is the erosion of their family wealth through inheritance tax. But the good news is there are a number of solutions to this, and we're going to talk to you about those today. One of the questions a lot of people ask is, should I give some of my money away? Can I afford to give money away to my family, to my children? And it's a very difficult question to answer. We've developed some cash flow modelling that we'll share with you that enables us to help you understand how you would make that decision. And very importantly, we're going to talk about family trusts and how you can control your wealth for your family throughout the future generations. Foster Denovo Group was established in 2005. Our flagship office is in the Weybridge area, but we have 80 partners being looked after by 140 staff throughout the country from 8 offices. Those delightful looking people are all here today. Myself and Andre and my colleagues, Dave Wilkinson and Sally, are all partners in the private wealth division of the group. As well as having 25 years experience in financial services, we're affiliates of the Society of Trusts and Estate Planning. It's a very difficult accreditation to get. Very few financial services firms have it, and only a small number of law firms have it. So hopefully we can talk to you today on this matter with a degree of authority. Within the audience today, there are a number of our existing clients, and it's nice to see you, and also a number of people we've never met before. And it's obvious to us that the knowledge that you all have will vary hugely. Some of you may well be advanced in your estate planning, and some of you have come along today because it's something that you've been meaning to get round to. And therefore, because the knowledge varies so much, we're having to put a presentation together that hopefully covers as many bases as we can, and hopefully we've achieved that. We are going to endeavour to have some time for questions afterwards. Questions on this nature tend to be very personal, and for that reason we've organised canapes and some wine and soft drinks afterwards, and we'd be delighted for you to join us afterwards if you'd like to talk to us about your own situation in the area where we had coffee earlier. So why are we presenting on protecting and preserving family wealth, and perhaps why have you attended? Well, I think that we're living in interesting times. Inheritance tax is on the rise, not because the threshold is increasing, but people's wealth is increasing. The threshold for inheritance tax in the United Kingdom is 325,000. The average house price in the southeast is 320,000, which basically means most people who own a property in the southeast will potentially be caught by inheritance tax. And at a rate of 40%, it can have a very big impact on people's wealth and their family wealth. As you're probably aware, many of you in this room are referred to as baby boomers, people born between 1945 and 1965, and those that have lived through that generation are considered to be the most wealthy, not just in the UK, but in the world as well, and possibly the most privileged. This is showing you the birth rate of people in the UK, and the red is highlighting the period of time when it's considered that people have the most wealth. And why is that? There's a number of reasons. One consideration is that they existed through the Thatcher years, 79 to 1990, and a number of things happened over that decade. One was the property purchase boom. It wasn't possible to own a council house before 1985, and the right to buy basically meant that house ownership started to expand quite significantly. Over 50 national companies were either privatised or sold between 1979 and 1990, and that made a lot of executives very wealthy, and probably more importantly meant that a number of people who had previously never owned shares started becoming shareholders, and that had an impact on equity markets. The FTSE was below 2,000 in the 80s. Okay, it's nearly 7,000 now. People who have owned shares during this period have benefited quite significantly. As well as the number of houses being bought, the average house price has increased hugely. The average house price when Margaret Thatcher took office in 1979 was 15,000. When she left, it was 65,000. In the southeast today, it's 320,000. And a lot of people started their own business. People left employment and started building businesses up, which basically meant a lot of people have been very successful. And we have a situation where a lot of people, certainly in the southeast, are in a position where they have a lot of wealth, they have a lot of equity in their property, they've got pension funds, they've got cash, and they've got investments. But what about the next generation? What about children and grandchildren? Well, I think it's fair to say that most of us will probably agree the situation is very different. Let's look at house prices. We talked about it a minute ago. We know house prices increased hugely during the 80s, but what about more recently? Let's look over the last 7 years. House prices in the United Kingdom have stayed relatively flat. House prices in the South East and London have continued to increase. The impact on house prices throughout the country, not including London, is actually slightly down. But in the South East, they've continued to increase. And if you consider that the average house price in the South East is 320,000, we can see with a degree of certainty for a first-time buyer, they need a 20% deposit, £64,000. So they need a mortgage of £260,000. Vince Cable 2 weeks ago said he thinks that borrowing should be restricted to a multiple of salary like it used to be, and he suggested 3, which really means you need to be earning £80,000 a year to get a £260,000 mortgage to buy a £320,000 house. How are people going to afford to do that? Think back to when you bought your first property. How old were you? And what do you think the age is today? It might surprise you to hear that it is 37. 37 is the age that the first-time buyer buys a property because they can't afford to do it before that. What about education? It's quite expensive to get educated in the United Kingdom. Some journalists are suggesting that the average debt for someone going through university could be as high as 53,000. How do they come up with that number? Well, tuition fees are 9,000, accommodation 4,000, food and drink, the Union Bar 4,000, and miscellaneous 1,000. Over 3 years, it's easy to see how young people may build up significant debt. And this is all resulting in the fact that the next generation need help. Currently, 1 in 3 people rely on their parents, and the bank of mum and dad is often coming into play, giving money for property purchase to help them get their foot on the housing ladder towards education. And our view is this, that if the generation of the baby boomers and the people before that have found themselves in a situation through hard work, perhaps through a little bit of luck, but a situation where they're sitting on a lot of wealth, what we think is what they don't want to have happen is that money be eroded, and it can be eroded through 3 ways. One of them is inheritance tax, second is the social impacts, and third is care home fees. And to discuss the first with you, I'm going to hand over to my colleague, Andre.
Okay, so if we're going to start talking about inheritance tax itself and how it's actually calculated and some solutions for it, let's first of all look at what forms part of an estate. Pretty obvious, but it's a few numbers just to talk around it. Obviously, it includes property, assets like cars, even things like ISAs. Interestingly, there's over £433 billion in ISAs in the UK. And as that stands, virtually all of that is going to be part of an estate for inheritance tax because they're not vehicles that you can put outside the estate from a tax point of view. 433 billion. Other money sitting in other investments, perhaps fine art. And also, if you make a gift to somebody, you have to survive 7 years before that gift actually comes fully outside of your estate. Otherwise, the gift comes back on your death and is taxable. So there's lots of bits and pieces that form your estate on death. So numbers, David's already touched on some of these, but let me talk you through one or two numbers. Obviously, if you've got an estate that's worth 325,000, there's just one of you. The nil rate band, the amount that's taxable that you can pass, tax-free that you can pass on to somebody is 325,000, so you would have no tax to pay. Obviously, as the estate grows in value, you can see obviously that the amount that you pay in inheritance tax grows. So if you're fortunate enough to have an estate worth 5 million, you might be paying nearly £2 million in inheritance tax. Now, interestingly, the Office for Budget Responsibilities that do the analysis of these numbers have predicted that by 2018-19, the IHT bill will be nearly £6 billion in the UK. And interestingly, the amount of families that are having to pay this tax is increasing by about 9,000 families a year. So more and more people are being brought into this net, as David's already touched on, because of rising property prices and rising asset prices. So what are typical estate planning objectives? When we talk to our clients and the people that we see, what are the typical things that they're looking to try to achieve when they talk to us? Well, they want to protect their family wealth from what we describe as third-party claims. And what we mean by that is typically perhaps there's divorce, and they want to make sure that money gets passed down to their children and not potentially out to the spouse and maybe their new husband or wife. So they want to try and keep it in the family tree and in the family bloodline. They're wanting flexibility as their circumstances change. As we've already touched on there, they might need to potentially help out their children and maybe their grandchildren, and they want some flexibility on how they do that and around their own situation. They obviously don't want to impact their current lifestyle. They may well be saying, I'd love to be able to help out my kids. I don't know if I can afford to do it. What if I need the money in 10 or 15 years' time? They maybe need it now, but I'm not sure I can give it now, and I don't want to impact my lifestyle. I also want to make sure perhaps that I pay the minimum amount of inheritance tax that I can. I've paid income tax all through my life on my money. I've potentially invested that and made hopefully some capital gain, and I'm taxed on that as well. Do I really want to pay inheritance tax on that again when I'm trying to pass it down to somebody? It seems pretty harsh when you're getting taxed all ways round. What else do they want to do? They obviously want to make sure their partner's looked after if they die. You always want to make sure there's enough money for your other half to make sure that they're okay. But you also want to pass money down to the children in a flexible and tax-efficient manner. We don't want to do something that potentially makes it difficult for them in the future, or maybe gives them a tax liability in the future. So that needs some planning. We want to try to avoid the pain of probate for our loved ones. Typically, a probate process can take anywhere between 6 to 12 months. I've seen those last longer. And again, you may want certain bits of your estate to go straight to your wife and children, quickly avoiding the need to go through probate. And we'll touch on probate and wills in a moment. We're also potentially needing to look after minors and the incapacitated, and what I mean by that, we have clients who have children that have certain disabilities, get certain state benefits. Depending what they receive from their parents, they could lose those benefits. Very important that things are structured correctly in how you're looking to pass money down to them and how they're going to benefit. So what we find, pretty typical, that estate planning is really a balancing act between these things. We're trying to mitigate tax, we're trying to keep access, we maybe need to control, and we're trying to juggle these things around. So if we're doing this, what puts people off? Why don't people do more estate planning? Why is there such a large amount paid in inheritance tax? Well, there's obviously a few things that we see with the clients that we deal with. We're concerned about the loss of that capital. As we've already touched on, they might need that income in retirement. They're maybe not sure if they can afford to give away that money because they may need it to live off. So that's obviously important. Concerned about that flexibility. Situations change and they normally want to be able to change with it. If you're made plannings, you might think, actually, I'm locked up in that. I've done something now that I can't change and I wish I hadn't done it. There's a perception that a lot of estate planning can be very complex. Some of it indeed can be, but some of it can be very simple. So there's a fear of that complexity about arranging some of these things. And as already touched on, there's that change of circumstances. You might potentially think, no, I'd really like to give money to one of my children or grandchildren, and something may change in the future where you wish you hadn't, and you can't unwind that potentially. So I think that's quite important. That's all right, no problem. So what I'm going to do now is take you through very briefly, and again, as we touched on earlier, we're trying to strike the balance here between giving a great big technical presentation and giving enough snapshots where you can get an idea. So we're going to try and cover 8 strategies for protecting your family wealth and also helping to reduce your inheritance tax. So We're going to cover first, we're going to cover wills, we're going to cover a strategy which is actually spending it, and we'll cover how that actually works, what you can do in terms of gifts, something called the use of business property relief and how you can invest using that. Very briefly on something called a discounted gift plan, a type of trust called a flexible reversionary trust. We're going to show you how you can provide for the tax. So if you don't actually want to do one of these things but still want the tax to be paid by some other way other than the estate, how you can do that. And then lastly, I'm going to hand back to David, who's going to cover in more detail the use of trusts and what we describe as bloodline protection. So the first one of those is wills. Now, it is amazing when you look at wills. You might think it's the basic cornerstone of really the whole estate planning piece. In 2011, Standard Life did a survey, and they found that on their survey, 61% of people didn't have a will. I won't ask for a show of hands here, but we're always amazed the amount of people we come across that don't have a will or have one they did when the kids were young, and now they've left and grown up, and they haven't updated it for years. So the will is really, really, really important. Where it's key is you might be surprised, or you might not be, but you might be surprised to know that if you're husband and wife and you die, your spouse doesn't automatically get everything. What happens is this. The spouse receives all the personal property and belongings, what they call chattels of the person that's died, but then just the first 250,000 of the estate. And they get what's called a life interest in the other half. In half the remaining estate. So they can get income from it, but they don't have it. The children get the other half of the estate after they've paid the inheritance tax, of course. Well, David had a meeting with a client 2 weeks ago. Someone has just sold their business for £30 million, and we're sitting talking to him and his wife. She thinks that if anything happens to him, she's loaded and really well taken care of. She was absolutely shocked to understand that this is actually what would happen to her. So, will is really important. If you do nothing else from today, perhaps other than organise a will, go and do that. That's a major thing. So you could spend it. This is a strategy for making sure you don't pay inheritance tax, reduce your estate. But you have to spend it on stuff that doesn't have a value. You can't spend it on a nice car that's going to form part of the estate. You've got to spend it on holidays and lifestyle, and you can't take it with you, so why not? But you've got to be careful what you spend it on. You could make gifts. Now, gifts are potentially useful because once you've survived 7 years from making a gift, they're outside of your estate. But if you die within those 7 years, there can still be tax to pay, potentially the full amount. But certain gifts are automatically outside of your estate for inheritance tax. So you're allowed to make limited gifts to your children of $3,000 a year. If one of them's getting married, each parent can give that child $5,000. Grandparents can give $2,500. And you can make unlimited gifts to whoever you like of £250. Not going to make much of a dent in those estate figures, but you could potentially do it. You're also allowed to make what are called gifts from normal expenditure. So if you can prove that you can fund something out of your income, you're allowed to give it away, potentially within these regulations. But you do have to be careful with these gifts. So what if you potentially have got, you've got assets, but you're saying, no, I think I really need this capital. Is there a way that I can keep my money invested but have it not count for inheritance tax? And the answer is yes. You can invest in something that qualifies for something called business property relief. And what we mean by that is investments like on the alternative investment market, the AIM market, things like agricultural lands and farms, and also some bespoke plans that have been developed around that legislation to take advantage of those rules. Now, the benefit of investing in something that qualifies for BPR is once you've held it for 2 years, it's completely inheritance tax free. Now, this has recently been extended to AIM portfolios sitting within ISAs. So that 433 billion that I talked about earlier, some of that could stay within ISAs but move to an AIM portfolio potentially and be outside of the estate. The problem with AIM is for a lot of people, they think it's a very risky, it's a very volatile market to be in. It's all well and good having the tax break, but if I see my capital go down by half, that's not really where I want to be. Well, the good news, it doesn't all have to be like that. This is another example, 3 little graphs on here. The light blue line is the FTSE All Share. So some of you may be invested in a FTSE tracker, and you can see that's the kind of volatility. They're the ups and downs in the last 5 years. Obviously, the last 5 years we're going from the bottom of the credit crunch. You look at the 2 previous years before that and you saw some pretty hefty falls, but you get an idea of what that's done the last 5 years. The orange line is the AIM market. And as you can see, it is quite highly volatile. You've got some big spikes upwards, some big spikes downwards, and that's maybe the kind of volatility and risk that people don't really like. The dark blue line there is an example of a portfolio that we have access to, and you can see there that actually it's got fantastic results in terms of performance numbers, and actually statistically it's got about 3/4 of the risk of a tracker. Well, that's potentially a really good solution. So AIM doesn't have to be risky. It can be, but it doesn't have to be. So number 4, and again, I'm not going to get technical on this, but this is something called a discounted gift plan. So if we're in that example, we say, well, I can afford to maybe give away some capital, but I still need some income. How can that work for me? What one of these does, very simply, is we might say we put £100,000 into one of these, and we'll take a £5,000 a year income, help supplement our pension. So we receive that money, and the value of the gift for inheritance tax purposes is actually what you've taken as income. The value of the gift is £100,000 minus what you've taken as income, and that's worked out actuarially. Now, I'll give you a bit of an extreme example just to make a point of how this might work. So I say this is a bit extreme, but hopefully it illustrates the point. You might have an estate that's got a house worth 325, the average price David keeps mentioning, but maybe you've got cash of £700,000. And as you stand with that, if you do nothing, you've got tax of 280,000, and you've got an estate that's worth just under 750 to pass on. If, and it is an extreme if, but if you took that 700,000 and put it into one of these discounted gift plans, the immediate effect is the tax is reduced down to under 150,000, and the residual estate now is getting over 850,000. We've made a big difference. After 7 years, the effect is that we've got all of that outside of the IHT framework. So it's an extreme example, but just shows you what potentially can be done using these things. So let me give you another case study. Here's maybe a typical family. We've got Grandpa, the children Marge and Homer, and the grandchildren Lisa, Maggie and Bart. Potentially, Grandpa's just won the lottery. He's got £1 million estate. He's got money in a property. He's in good health. This pension is going to satisfy his income needs. He thinks he can give away some capital. He wants to help out the children. He wants to help out the grandchildren. But maybe he needs long-term care fees in the future. He's not sure what he can and can't do. And he may need some more income. So he wants to help Lisa. She's going off to university. Bart isn't. And we see where that goes from there. So what could he do? He could set up something called a reversionary trust. And very simply, again, without getting technical on this, we set up the trust, and inside is a series of payments. And each year, that person can decide whether they take those payments or not. They might decide to take all of it, some of it, none of it. And if they want to, they might say, actually, I don't need that part, I'll stick it back to the end. And each year they've got a choice of whether they take that money to use for themselves, to pass to the grandchildren, to pass to somebody else, or actually leave that, I'm going to take that later on. So complete flexibility. So what it does, hopefully, is it balances the need for our future income and capital requirements, but it gives us that effective inheritance tax planning. We can start planning using the nil rate band. The settlor, the person putting the money into it, has got ongoing access if he or she needs it. We're not paying inheritance tax when we put it into that trust, so it's very efficient. And all growth is immediately outside of the estate for inheritance tax. So again, we're not making the problem worse by investing in something that's going to go up in value. And all of that initial capital is outside of the estate after 7 years, saving further tax. The children and grandchildren are not locked out while Grandpa's alive, and what that means is if he wants to pay money to them while he's around, he can do that. If he decides he doesn't need all that capital, he can make that decision. Okay, so you might be listening to some of those things saying, that's great, I'm really not sure I can give away the capital there, I'm not in a position to do that yet. What else can I do so that maybe I can pass over my full estate to my children? So I want them to get all the estate, but I know there's going to be some inheritance tax. What can I do about that? We can actually do something that provides for the inheritance tax bill separately, that means all the estate can pass down to the children. And what we do is a special type of life insurance plan. If you've got a husband and wife, it insures them both, but only pays out on the second death when the inheritance tax is due. It is potentially quite cheap. Here's an example, real numbers, couple aged 65, they could insure themselves for a couple of £100,000 worth of liability for just £45 a month initially. So they can do that. It's very flexible. They can alter what they're covered for and how long it runs for. And quite importantly, they've done nothing irreversible. They haven't given money away. They haven't put stuff in trust, although we're going to cover the flexibility of those in a minute. They're not making any decision that they can't unwind and change. So we find a lot of clients do these when they're looking at an intermediate step towards planning. Okay, so let me show you another example of how we use this. Again, a little bit of extreme example, but linked with a charitable donation, just to show you how this might work. We've got a husband and wife, Mr. and Mrs. Cameron. They've got an estate of £1 million, property and assets. 3 children, and at the moment, the way that sets up is the inheritance tax is £140,000. The net amount payable to the children means they end up with just under £290,000 each. What they could do is say, right, actually, I'm going to give all of my estate to charity. I'm sure there's a lot of charities out there that will take that money from you gladly. And what we're going to do is we'll do an insurance policy for £1 million that, again, in this example of those ages, costs us £50 a month. And what we're going to do then is we're going to make sure the children benefit from that money. So what happens then, the result, the outcome of all of this, the charity gets £1 million, the inheritance tax bill of $140,000 goes, and each of the children ends up with nearly £50,000 extra. So again, an extreme example. I haven't met anyone yet who put their whole estate to charity, but you just get an idea about how it might work with charitable donations and how that works from there. Okay, so we've covered some of these, and what I'd like to do, David mentioned at the start, we talk about cash flow modelling. So we've covered 7 strategies on how you potentially reduce your liability, protect the wealth. How do you know if you can afford to do this? You might be sitting there thinking, well, this is great, I'd love to do these things, but I've no idea whether I can do that. I've no idea what income I need 5 years from now, 10 years from now. How do I make sure I've got enough? So we use this to be able to create a long-term plan that enables us to put all this stuff together for you. We look at the expenditure, we look at what's coming in as income, we look at the asset base, and we look to see what you're going to have before and after retirement. Key thing is we want to make sure that you don't run out of money for yourself. Yes, we might want to spend it, but we need to have enough there. And if it's applicable and you want to do it, we're trying to determine how much of your wealth you can afford to give. So say we put all these bits and pieces into our software, and we get something that looks like this. And simply, without going into big detail on the colours, we've got someone who is working, that's the blue part on the left-hand side. They retire, and then their expenses, which are the jagged lines going up, are then met from things like their state pension, buy-to-let income, pensions, investments, ISAs, whatever it may be. And what we're trying to do with that is put all that together so that we don't end up with red, which is what we've got in the top right-hand corner. And that might be fine when you're 90, but obviously if we've got loads of red when you're 75, there's something not quite right with the plan. And that might mean you've got to look at your expenditure, what you can afford to live off, but it does enable us to look at what you can start to do in terms of giving. We have an example here. This shows you actual assets. So there's someone here with a couple of £1 million. We've got money in property, which is the grey line, money in pensions, which is the brown one, and then the other colours are liquid assets. And from here we can see that even after retirement, this person's asset base is growing, and we know then whether we can afford to pass money to the children or the grandchildren, and we know where it comes from. It might mean that we decide to downsize our property because we've got more than we need, and therefore what can we do with it to either supplement our income or to give away money to our children, or a combination thereof, or to use one of the trust mechanisms. Okay, so hopefully you've got a little idea about those strategies and how that works. I'm now just going to pass you back to David, who's going to cover the 8th strategy.
Thank you, Andre. So the 8th strategy, which is really the use of family trusts. And why do people use family trusts? Well, the first reason is for tax mitigation, okay, but it's important, it's not the only reason. I think the reason people consider using trusts is for what we call bloodline protection. And just to be clear about that, most people we speak to will say the same thing. When they die, they want their assets to go to their children and their children's children and their children's children's children. Most people want their money to go down the bloodline. We very rarely meet someone who disagrees with that. And without the right kind of family trust in place, there's a very good chance that that won't happen. And the third area is to do with care homes, and we'll talk about that, and that's something that's been in the press quite a lot, and we'll give you our comments and view on that as well. Remember, what we're concerned about here, and the whole principle of estate planning, is to basically avoid the erosion of wealth. If the same £100,000 was passed down 3 generations and each time it was taxed, it's generational inheritance tax. The £100,000 becomes worth less than £22,000. And the reason that's the case is that grandpa passes £100,000 to the son, and the son then passes the £100,000 to the grandchildren, and so on. If the same amount of money keeps getting passed down, it gets taxed each time. Usually that money doesn't always get spent, and therefore the wealth that's been built up can dissipate quite significantly. One, through inheritance tax, and then also through bloodline leakage, which is often referred to as divorce. And trusts and advice are part of the solution. So let's look at these in turn. Someone you'll be familiar with, Mr. Alan Sugar. This was in the Sunday Press a number of years ago. You're divorced. Apprentice star Alan demands £5 million back from the woman leaving his son. And I think the situation here is quite straightforward, is that, and it could very easily happen, if somebody decides to give money to their child to help them get their foot on the property ladder or start a business up, in most people's marriage, what's mine's yours and what's yours is mine, and very clearly that money belongs to the family, and if they split up, it's going to go sideways. And it doesn't just happen during lifetime, it happens on death in particular as well. And many of you will relate to this example. A very good client of ours, their parents were married for 40 years, the mother passed away, they're quite wealthy, and the father remarried 18 months afterwards. Now, I know this person very well, and I know that the mother would have very much wanted the family estate to go down to her 3 daughters and the grandchildren. That's definitely what she would have wanted to happen, and that isn't going to happen because the new wife is significantly younger, it's a good chance the husband's going to die first, and where's the money going to go? It's going to go to the new wife and then to her children. So without the right kind of planning in place, not only if you gift money or give money away during your lifetime can there be a problem, if you die, very often the money may go in a direction that you never intended it to. So the use of trust as opposed to direct giving can be very, very helpful in this situation. It is why it is often used. It is for control. It's for control, not necessarily purely tax saving. What are the current rules on care home fees? Well, if you became very poorly and needed to go to a care home, as you probably know, it's means tested. If your wealth is over £23,000, you should pay towards your care home fees. So paint this picture. A couple in their 70s have built up a lot of wealth, they own a property, they've paid the mortgage off, and their intention is that when they die, they hope that property will pass down to their children and their grandchildren. But what actually happens is the husband dies, and 2 years later the mother, the wife, gets very poorly and she needs to go into a care home. There's a very good chance the property will be sold. Now, there is deprivation of assets rule that basically is set up so the local authority can try and prevent people from 3 weeks before they get dementia and go to a care home. They set some fancy trust up. But if you put some planning in place that basically meant instead of the main property being owned jointly, which most of yours will be, it's owned tenancy in common. That basically means you each own half of your property. And what happens is that the person who dies first has already written a trust in place that says, when I die, my half of the property is going in trust, a life interest for my spouse and also for my children. In the event of the same scenario where the spouse becomes very poorly and goes to care home, the property can't be forced to be sold because it's not owned by the person going to care home, because there's a share ownership with a trust and the trustees don't want to sell the property. Now, clearly anything like this could be potentially challenged, especially if it's been done deliberately to avoid care home fees, but if it's been set as part of a estate planning programme a number of years beforehand, we've got plenty of examples where it's evidenced that it does work. So trusts are used to mitigate against taxes, to prevent against divorce, and also possibly to ensure that care home fees don't have to be paid. But let's just talk a little bit about trust, because it's something that a lot of people aren't too familiar with. Trusts were set up in the 16th century by landowners to protect their assets. The first anti-avoidance rule was brought in 1535 by Henry VIII, and trusts have been around for 500 years. So, it's not something as though this is a new thing that's been introduced by a few whiz kids to try and market. It's something that's been around for a long, long time. The need for the use of trusts is probably greater than it's ever been before because of what we've talked about with wealth increasing and more divorces and family breakups. And it's not just for the rich. A lot of people would imagine you need to be gentry and very wealthy to have a conversation about trusts. Not true at all. If your estate's over 325,000, I suggest you need to have a conversation about trust to find out if they fit into your planning. Some of the myths: they're very expensive to run. No, they're not. The costs are very palatable, which is why people we often speak to set them up. You don't need to lose complete control of your assets, which we've talked about, if you didn't need to. And a lot of people say, yeah, but the law's always changing, the rules are going to change. What we do know is within action is that you'll pay 40% tax on your estate and the money will leave your estate. So we can't guarantee the rules won't change, but you can only do planning based on the laws that exist at any point in time. And we believe there is a very good need for this kind of planning in many cases. So let me just talk a little bit about how all this works. Well, it isn't particularly complicated. When people think about a trust, really entities are usually an individual, a limited company, or a trust. They're the three main entities that exist in the UK. And a trust needs three parties. The first is the individual that settles the trust, known as the settlor, the person who sets it up. And that is the person who is agreeing that they want to take an action, which is possibly giving something away now or giving something away in the future. The second group of people are the trustees. Very, very important role. You have to be very careful of who you select as your trustees, because the trustees have responsibility, a legal responsibility, to ensure that the wishes of the settler are met. Trustees are not lawyers, okay? They are usually family members. They are your children or your brothers or sisters. And the third group is clearly the beneficiaries. Who are the people that are going to benefit from these arrangements? And in 90% of the cases that we deal with, the settlor are the parents, the beneficiaries are the children and the children's children, and the trustees, if the children are over 18, are also the children. Okay? Family trusts don't need to involve lots of third-party people and lawyers and accountants to act in this capacity. It often can be a family arrangement. So just to be clear, the people giving the money away are the parents, the beneficiaries will be the children and the children's children, and the trustees will often be the children as well. Okay? And what's very important is with beneficiaries, and one of the important things about trusts compared to gifts, is that with trusts, you don't need to specifically name who the beneficiaries are. They can be a category of people. My children and my children's children, which means it keeps it flexible and it keeps it open. Let me try and give you a really simple example of where this will be used. And this may apply to some of you in the room. Let's just take an example of somebody who's got a pension fund. So not a final salary scheme, but a personal pension fund. Maybe it's a SIP or a personal pension. And it's worth 600,000. And what the individual hasn't drawn the money from it yet. It's still sitting there. And his intention is that he may use it during his lifetime, but when he dies, he is hoping that it'll go to his children. He's happy that it goes to his spouse and then to his children, and he would hope that they would each get £300,000, because that's half of the 600. Reasonable assumption to make. Without proper planning, they'll each get 180, because 240 will go in inheritance tax. Now what's interesting, I find it very interesting how much time people put into analysing the fund performance and the charges of their investments to make sure they get good return, only for a huge percentage of it to be lost because the right plans weren't in place. Now, why would this happen? Well, first of all, in this example, the person who owns the pension fund dies and it goes to his spouse. I gave you an example previously. In this example, the spouse might remarry. Well, none of the money is potentially going to the children because it's all going sideways. So his initial wish isn't granted at all. But if the spouse doesn't remarry and the money does go to the children, assuming the estate is over 325,000 for an individual or 650 for a married couple, there'll be 40% tax. So not only could it go to the bud line, 40% has been lost in inheritance tax. It's a lot of money. We're not talking about a few quid, we're talking about hundreds of thousands of pounds lost purely because something very straightforward has not been in place. And by the way, less than 1% of people who have pensions have them written in trust. So how would you solve this problem? Very straightforward. You set up a trust. And the person who owns the pension bequeaths the benefit of that pension into trust. The beneficiary is the spouse. The spouse can have access to the money, but it certainly can't go sideways because the spouse's new partner isn't listed as a potential beneficiary. The other potential beneficiaries are the children. So in this example, we could say with a degree of certainty the pension will be used for what the person originally wanted it for in the event of his death, to the spouse and then to the children. The IHT has been saved. That simple mechanism, we can say with a degree of confidence, in a lot of people's cases, will save 40% of the value of the pension if they die before they draw the benefit. So in this example, relating back to what I showed you previously, the settlor is the person who owns the pension, the beneficiaries is the spouse and the children, and the trustees will be the spouse and the children. Now, if you consider, a lot of you maybe sit in the room and say, well, I haven't got a pension fund and that's not relevant to me. If you think through what we've been discussing the fact that a lot of people's wealth is going to dissipate because it's going to go directly, and for those that do have a will, 99% of them will say exactly the same thing. If I die, it goes to my spouse and then to my children. If my spouse dies, it goes to me and then to my children. That's what it'll say, because that's what most wills say. And our view is, if you think about everything we've been talking about, if it goes directly to the children, if they get divorced, it's going to go sideways, it's fallen into their estate, it'll be taxed again, and there's no control. So consideration should be given to simply this. We know that if it goes sideways, there are concerns. It should be given to the spouse, but either absolute or what we call a life interest. Okay? So it's written in trust to the spouse. Now, that's for if you're a couple to decide yourselves. Would you like your partner to inherit everything you have and you inherit everything they have? Or would you rather you each have a life interest? The benefit of life interest is that it can't go sideways, and that's for each couple to decide. But secondly, instead of going absolute to the children, in our opinion, it should go in trust to the children, because it really satisfies all the reasons we gave earlier. Let me just touch on something else that's very relevant, because we're talking about estate planning and care homes and wills, and it's lasting power of attorney. Okay? Lasting power of attorney is something that was introduced that replaced an enduring power of attorney a number of years ago. And everybody in this country has the ability to appoint an attorney. And what that is somebody who can basically act on their behalf. Now, you could do it because you went on holiday and you need someone to sign some paperwork. But what we're really talking about is if you became very ill. Okay? The Alzheimer's Society suggests that there will be 1 million people with dementia in this country in 2019. Currently, 1 in 5 people over 85 have dementia. It basically means that if that happens, you will possibly be considered as not able to make your own decisions about your finance and also your health. And if you don't have a lasting power of attorney, in effect, everything gets frozen. We've got a very good example where a lady owned a property. She was a very wealthy lady, and she went into a care home. Now, fortunately, a number of years ago, 2 or 3 years, it's one of Dave's clients, 2 or 3 years beforehand, she signed a lasting power of attorney to her 2 children, which has meant that her 2 children have been able to take some action to sell the property, to release some money, to make some actions with the investments, and very importantly, give advice to the medical profession on what they think the treatment their mother should take. Without a lasting power of attorney, that can't happen unless you appeal to the Court of Protection, which is time-consuming and potentially costly. And the one thing that you can't do, and what attorneys can't do, is set up trusts and alter wills. You can see there's a potential conflict of interest that could occur, and the rules on that are quite strict. Now, the number of people that have a lasting power of attorney in this country is very, very small. And it isn't particularly expensive, and we would consider it best practice as part of everything we're talking about to have something like that in place, to be fair, whatever your age is. The last couple of slides from me, this is something that lots of people talk to us about. They go, I'd love to help my grandchildren with their education. I'd love to pay for their school fees. And an obvious thing to do is simply give the money. Now, for the same reasons I don't need to repeat, why would you give the money absolute when you could do it through a trust? You could set up an education trust, the money could be passed into it, the money is lent out from the trust by the grandchildren or by the parents of the children, and the key thing, it doesn't form part of the estate, it can pass from generation to generation. It's a pretty effective way of passing money down for the purpose of giving children education in a tax-effective way. We haven't got time to cover all the things that we can do in this area, but as I mentioned earlier, it's not for the very wealthy, it's for the majority of people. Life assurance policies should be written in trust, less than 1% are, which means that people die, the money goes in the estate, and it's inheritance tax is paid on it. If it was put into trust, it wouldn't. Same with a pension. Andre's talked about giving money during your lifetime. There are benefits in giving it absolute. There are certainly benefits in transferring it into a trust and doing so. And we've already talked about the residual estate. If two people die, what happens to what's left? And our view is a beneficiary protection trust framework is really healthy and really good idea. Andre talked about it earlier, but if you have a situation where people have their children or the potential beneficiaries are very young or possibly disabled, I've got a very a good client, and his son is quite poorly and has care, lives down in Brighton and has Asperger's. And we've had this conversation. He said, the biggest fear I have is anything happens to me and my wife and my son gets a cheque for £3 million. I mean, it'd be a nightmare. And so the trust has been set up because it basically means, and it's not for tax, it's for control. My client can feel confident that if anything happens, because we've appointed the trustees, he knows his son is looked after. He only did this a year ago. His son's had Asperger's for about 7 years. If anything had happened before that, and he says, I hate to think what that would have meant. A lawyer going, there's £3.5 million. So what hopefully we've done before I hand back to Andre is, for those that knew nothing about estate planning, hopefully you now know something, and for those that already had a good understanding, perhaps you've learnt something you didn't previously. As I said at the beginning, the key thing here is ensuring what we describe as the right people. You know, if you think about it from your own perspective, who would you want to get the money if anything happened to you? Do they get it in the right way and in the right time? And without the right kind of plans in place, I think we demonstrate that wouldn't happen. And so hopefully we've given you some examples of how that does work. We've given you some scenarios and some examples of how you can protect and preserve your family wealth. We've explained it in plain English, but I guess that's for you to let us know afterwards. We've talked about the optimization of estate planning through cash flow modelling. You know, I assure you that's something that we have only introduced in the last 2 or 3 years. It's made a huge difference to the relationships we have with a number of our clients. They've really enjoyed working that through. It's really helped them with a lot of decisions that previously they would have found difficult to make. And we've talked about how trusts, you know, aren't as complex and as mythical as many people believe them to be, and that they should form part of many people's estate and planning. And to close off, I'm going to pass back to Andre.
Thank you. Well, hopefully, as David said there, you've found some of that information useful. Maybe it's expanded your knowledge a little bit, or it's reinforced what you already knew. and hopefully we've got the balance right. As you can appreciate, some of these areas can be quite technical, and trying to keep them so that you can do them in a PowerPoint in under an hour is quite tricky sometimes, but hopefully we've got that right balance. What I'd just like to spend the last 5 minutes doing is, obviously we've done this event today, we've hopefully given you some good information that you can take away and do whatever you want to do with. Why are we doing it? Why have we held the event? So if it's okay, I'm just going to spend 5 minutes just giving you a little bit more information about us and how we work. You may well be sitting there saying, well, that's great, guys, but why are you doing this? Cover a little bit about awards for us. David mentioned our size earlier. We're very proud of what we do as a firm. A couple of things we're particularly proud about. We're nominated this year for the Professional Advisor Award for Retirement Planner of the Year. The big thing for us, perhaps, with awards, the biggest publication in our field is a magazine called Money Marketing. Last year, we won IFA Firm of the Year. We're absolutely delighted with that. So for our industry, it's probably the biggest award. And this year, we were runner-up again. So it may not be things that you've heard about, but for us, I think hopefully what it demonstrates is a firm that knows what it's talking about. And as Dave touched on earlier, has got the size and scale. We're a big player in our field and more qualified than most people out there. So hopefully you can gather, we like to think we know our stuff. A little bit of our proposition at Frost & Over Private Wealth. What we've covered today is two parts. We've covered the estate planning, a bit of wills and trusts, a bit of background on that, and we've given you just a taster on how we work with cash flow modelling. Now obviously we're a firm of financial advisors, so we do everything else you'd expect a firm to do. Advice on investments, pensions, general insurance, VCTs, EISs, mortgages, general insurance. So we just touched on those couple of parts, but obviously we cover all those areas as you would probably expect. So how do we work? You might be sitting and saying, that's great, so how do you boys operate? What is it going to cost me? How does it operate? So hopefully the way we work with our clients initially is, once we've perhaps had an initial conversation on the phone or something, we would have what we describe as a discovery meeting. And the idea of that meeting really is to get to know you, your objectives, what it is you're trying to achieve, and that meeting is at our expense. We're not going to put you on the clock. There's no bill for that. And hopefully by the end of that meeting, we can really demonstrate the kind of value that we can add to your situation. And Dave's already mentioned going through there on the Asset Preservation Trust and the use of pensions. Hopefully there you can see, we'll put a bespoke strategy together for you based on your situation. And we'd like to think we can add massive value by doing it. You take the example that David had there of the pensions. Potentially the strategy we're talking about saves £240,000 in inheritance tax, and it costs less than £1,000 to implement. So again, we'd like to think there's a lot of things we can do there that really show you the value that we can add. We obviously put all that strategy into place. We're not just going to tell you what to do and then you've got to go off and find a way to organise it. We can take care of all those bits and pieces for you as you would expect. And there's an ongoing service there which is really important, because we've talked about in the other slides about changing circumstances, flexibility, and if you're looking at these things regularly, reviewing them, looking at a cash flow model, it's very important that you know about those things. You know about changes in legislation, tax, what happens in a budget, how does it affect you. So obviously all of that stuff is kind of part of the strategy, and it's really important that we're having those regular reviews and giving you that information. But the key bit for us is that initial part where we're really getting to understand you and hopefully giving you some ideas of how we can really help you and add some value. So what are the next steps potentially? Well, we really would value your feedback here. You've got some feedback sheets. We're always looking to improve these things. We'd like your feedback, good or bad. We can take criticism, but if you like certain bits or don't like certain bits, your feedback would be excellent. We really think this venue is a really interesting place to come and hold a seminar. But again, your feedback would be really, really useful, please. If you could do that, that would be great. So if you could hand those in before you leave, that would be brilliant. We've got, as David mentioned, canapes, wine, soft drinks, tea and coffee. By all means, just go and have those. You've seen the AMG suite. It's quite an interesting place to have a drink and just mull around what's going on. You are welcome later on to wander around the whole venue. We're not being locked out at a certain time, so if you want to have a wander around later, you can definitely do that. Obviously, feel free to grab one of us. There's myself and David and David and Sally over there. If you want to ask us a question or just ask us to that you'd like us to contact you or something, please please come and grab us. That's fine. If you've got a question, that's great. We were intending to be giving you a call and giving you a little telephone debrief. The reason we do this, as we find from other seminars and other people that we talk to, is they really value the chance to have a quick chat on the phone about what they've experienced, and they might have particular quick questions they want to ask. Perhaps it's difficult in a room to look like there with drinks to do that. So we would have a little debrief, talk things through and see whether it is something that you'd like to talk to us further. We find that the other people that we talk to at these seminars really enjoy that. So we'd like to do that. Obviously, you've got contact details for Aoife, the lady that was sending you the contact for the seminar, and following those up. So if you can't get hold of one of us directly, you've got her details. So it just leaves me with a final. Are there any questions that anyone would like to ask out here in front of everybody else? If there are, we're happy to take those. And then what I would say is we have to have all the disclaimers up there, but thank you for your time. Thank you for taking time out of Wimbledon and the World Cup to come and listen to us. I hope you've enjoyed it and got something out of it. If there's any questions, then please feel free to ask, and we'll obviously answer if we can.